All right, welcome everybody. We came, we saw, we conquered. It was I guess the week last week of it depends the election outcome. With almost, I'm not quite sure if the House is completely decided yet on counting of the votes. It's only been a week, but Trump wins, market gets excited, and what was the big number one trade that we were promoting for quite some time? And not only that, but you guys have seen my newsletter and the trade recommendations, and we've been pretty transparent there about the Russell and using options and option spreads going out even from December, and even using the January strike or call spreads, the January expiration. 6% upside gap higher in the market in the IWM. This actually surpassed my expectations in that short period of time. And yes, we took partial profits on a lot of those trades up here. Next trade, looking at the indicators, just to tell you, I would not be surprised to see the market pull back, maybe partial and this is going to be a tough one. Yesterday on Veterans Day, and by the way, a delayed thank you and salute to all our veterans out there and family members of those who had served. Our due respects. We were talking about this market up here around 241. Maybe there'd be a little bit more follow through. And quite frankly, we didn't quite get it. But my recollection of telling my clients, and also what we did from the newsletter perspective and our positions, was to take some money off the table on this rally. And one of the things, and I call this my Sergeant Hulka, the big toe indicator, my advanced decline, the JP Mick oscillator, and then my volume tool, new highs, and volume wasn't there. Take some money off the table. I still think we're going to get an end of year January effect rally, but we should see a pullback. And my 2 cents is, what's the pullback? Well, if everyone got excited and started buying between 237 and 240, odds are we come back and test the low, at least the low for the move of last week's gap higher open of the reaction, the election reaction. So I would want to buy the January and a pullback somewhere between 228 up to 230, somewhere in that zone between 28 and 30. Call it, the average point is 29, I guess. But somewhere in there, I'd start looking at buying and pricing back in the 234 and maybe the 235 to the 250, and start doing like 12 and 15 wide spreads for this the January expiration, and give yourself some time. I'm not going to get much into that right now. We got a lot to cover. We do have a situation brewing in the market. It got real excited with the Dow Jones Industrial Average. New highs without confirmation, bearish divergence on the breadth of the market. Volume's okay, but this is the JP Mick oscillator. Today we closed under the zero line. So that could be considered a zero line reject, and maybe we fill that gap in here as well. I really don't have exposure to, with some individual stocks possibly in our fund, but for Dow indicators, or excuse me, options trades, I don't have any exposure, long or short, really, to the actual diamonds. My focus is going to be in the Russell. I think there's bigger money to be made there, and we could get a pullback. If I take a look at the condition of the market internals on all the indices, the NASDAQ comp, the Dow, the the Russell, and even the SPY. The SPY was kind of weird because it too has this really bizarre bearish divergence. New highs in price, lower highs in the advanced decline comp ratio line, with, again, a negative zero line. Now, maybe the market took a little bit of profit and didn't, got too accelerated to the upside on the election bump. But we are starting to see something that's unique, is that the rally came at an increase in volatility. And the 10-day ATR, when it typically rises, it can be a harbinger for, it shows that there's an increase in volatility. And it could be, if we see another day or two of increase in the ATR, it could signal that the market has more of a pullback coming in the market. 3%, I'm not quite sure, but we'll let you know day by day, week to week on the YouTube videos. A couple things that I wanted to just come back and focus in on. First and foremost, about a week ago, I said, I don't know about DraftKings. I'm more inclined to be a positioned in MGM bets and buy on relative weakness. And we got some relative weakness here on MGM. So we're looking at adding to some positions down here. But another stock that we had for our fund for traders here was on Humana, which did not get a 30% bump, but boy, it did get almost a 25% increase. And, Humana is another one of these stocks that it just got absolutely berated. And again, if you get an opportunity to buy dips and at support, and I'm not quite sure we'll get there this week, but this week, next week, buy against this base in here in Humana, and I think you'll see some, you'll have a happy face at the end of the year. We have this other stock I was talking about that's just absolutely going down to zero. We have a setup but no trigger, and still we don't really have, the volume actually got worse, not better. It was setting up, but no trigger. So this is Estee Lauder. I mean, how low can it go? You guys, if you watched the last video, I said, listen, it can go down for a while. This is a stock no one ever thought would get that low. It was Walgreens, but yet every month and every week it just kept plunging. So yeah, stocks can go a lot cheaper than we think. LVMUY, Louis Vuitton. I set this one up and saying, hey, be patient. And I don't know how many weeks it's been going on. And I said, wait for a pullback in the 120, the 120, 120. We got just darn close at that number today. And we took a nibble and have entered some longs on Louis Vuitton. We're one thing that we're at that you can't see, it's kind of like a hidden value. It's called the person's pivot point. It shows hidden support resistance. I don't mind, and I think that in past history, the green quarterly been a strong, both it acts as a resistance and a support target, and then we've come into that support. Volume for the month is not that bad. So it's fallen on light volume, which means maybe we could get a little bit of upside. So I like the Louis Vuitton trade. Remember what's under their staple of companies. That not only is it Louis Vuitton, it's Christian Dior, I believe Tag Heuer, also Sephora. You have Moet Chandon Champagne. So I mean, they just have a plethora of sub companies underneath their umbrella. Plus, don't forget, they own a lot of real estate of where their stores are located. So they own the actual building. So they got that going for them. Another trade I'm going to talk about is it's coming up to the holidays. Is Walmart going to take market share all the time, every day? Is Costco going to take all the market share every day, all the time? Or is it time for Target to shine? Target's got earnings next week, and one trade I think you could look at, and this is kind of like a higher equity type trade, but a good strategy nonetheless. Earnings are on the 20th, but if you look at the November 29th, 165 strike calls. You can collect about $5 on those. And if you can get in the stock itself between 155 and 153, I think that's a decent trade, at least over the next couple days. I think this is a stock that I've been waiting for it to come down, but with the selling of the premium, and here's the trick to this strategy. You got earnings out. So if earnings are bad, you're going to be willing to hold the stock through that earnings and the guidance going into Q1. If the earnings are really good and the market accelerates and gets through and above the 165 plus the premium you collect gets near 170, you're going to be called out of the trade, but a nice trade nonetheless. So that is a trade for the fund that we're looking at and engaging right now. So there are a couple things. Now, China. Trump's going to put China out of business. I don't really think that's the case. And of all the Chinese stocks, it's Alibaba, and we are starting to nibble back again. Now, remember, I was one of the few people out there in the world that kept telling everyone, look, higher lows, eventually we're going to get the big rally. And while the world was buying into this, we unloaded our longs. Well, guess what? I'm looking now that the market's pulling back on bad news. I would gather to think that bad news, once the CNBC crowd and the Fox News and the Bloomberg were saying China's implementing a stimulus package, it's good for their stocks, it's going up, and everybody and their brothers and sisters, you probably know this and remember this, they all said, oh, now's the time to get exposure to China, and they all rushed in probably between 113. I don't know if anyone bought the exact high up there, but I would say people had a time to get into this range in here from the time it broke out and the pullback. So, between 110 and 115 is a good assumption of where people's average holdings are. You start looking at a stock now with bad headline news. China's going out of business and Trump's going to put them out of business, and tariffs and lions and tigers and bear oh my. I still think it's got a valid longer term story, intermediate term story, and there's not a lot of heavy volume coming in on the selling pressure, and even my volume indicator has got light momentum of selling. It's now into oversold territory, and that just tells you that on any more relative weakness, filling some gaps in here between 90 and I don't know, maybe we could get to 86, as it would be a challenge against an old swing high. If you think about it, someone is not going to probably hold the stock they bought at 115 all the way down to 86. They're probably going to pitch the position. So this is why I like buying it down and into that area. So this is a kind of a strategy that I would employ, that I do employ. It's called scaling in. I buy a little bit because, sometimes in this stock market with all my technical indicators, despite the fact that pivots support, they have strong support, it holds, it bounces, we could see that back and forth. I also want to see what the condition of the market is, right? So the condition is we've got a weak volume sell-off, and we got gaps down here to get filled, and maybe people liquidate and throw the trade out on bad headline news. And if there was any bad headline news, having President Trump, implement a more harsher trade restrictions on China is probably doing it, right? The funny thing is, I don't know what is, Alibaba's not one to really export a lot of stuff to the U.S. So they're more unique other than other companies that are in China. Now, maybe investors have that panic and that fear, but remember, they are the AI. They're kind of like the Amazon of China. So therefore, they also did, I think, a $10 billion deal with Indonesia. So we got to look at that as well. So they got at the Asia Pacific Rim, they've got that exposure there. And also don't forget what Alibaba did. They also hooked up and linked in and provided technology and artificial intelligence image graphics to the Olympics. They were one of the sponsors. So the Summer Olympics in Paris, by the way. So I'm prone to that. There's a company called the parent company of Temu. You see their products maybe advertised on either Amazon or on YouTube or TikTok or wherever. Temu got a gap down here at the market around 102. I'll be looking at that as well because, again, look at the momentum of the volume. It's not as strong on this big decline. So hopefully we get a little bit more punishing downside action, and I'll take a stab at PDD. JD.com. That's got a lot more to come before it comes back to the old swing high and the gap level. That's $30. It's at 36. So we need about a 20% decline there before that tweaks my interest. Look at the volume. It's not as prominently divergence as the other two names were. So therefore, that's my what I would be looking for as far as China. AMD. Nobody wants AMD. It's been giving it up for dead because, the whole semi-sector in the Biden administration has imposed restrictions on chip sales to China and related areas. But again, any move between this next, that swing low, which is like 38, we test that, take it out just a bit. This little a support, longer term support, and the pivot support around 135. I'll be buying in on AMD. So there are some areas that I think that we could look at buying relative weakness. Here's one. I'm not buying it, but they had earnings. People were all excited. It was up 6.5%. Let me show you this. It's Advanced Auto Parts. This may freak you out a little bit. People talking about a stock that was up 6.5% off the lows just this last week for earnings, or this week for earnings. I'm sitting here going like, what's wrong with people? This stock was a $250 stock over a year and a half ago, not even a year and a half ago. I guess you could say 2 years ago. Advanced Auto Parts, and now it's garbage. It could go up 6%. It needs to go up 500% before it gets anyone's real attention, right? So until we get some better longer term, I'm not really one to say, hey, let's take a look at Advanced Auto Parts right yet. But I just thought it's interesting to note how things can be massaged to make us investors, if you don't go back and do your due diligence and look hard enough, some people might get all excited about certain things, and it's really not that big a deal. It needs a lot more work before it gets my attention. That's all I have for tonight. It was interesting to note that the holiday trades and the Black Friday specials, a couple things that have my interest. It looks like Target is starting to get some better interest in basing action and better technicals. So I think that covered call strategy might work for some. And then lastly, the last trade I'm going to give you is Google. Now this is kind of a wimpy trade because it's not an immediate trade, but I think it's not just a safe trade. I think it's a stupidly good trade. The odds of Google to go back and make a new high or test 200 between now and say February, probably pretty good, right? And so the 190, 210 for February expiration. Go look at those monthlies and see if we can get those for about $4.25, $4.25. I mean, that to me is a pretty decent 20 wide spread for $4 on a stock that you don't have to worry about the holidays. You don't have to worry about sanctions, Department of Justice here or there. It's got some great intermediate term weekly volume action. And I think if there is any follow through for year-end strength and also the first few days of the month of January, new fresh buying, this is a stock that could certainly rip. And for an option strategy, $400 down per strategy is a great risk-reward ratio. Anyway, consider that one. We put that in our live trading room the other day, and it's actually up money, but I thought I'd just share that with you guys on the YouTube channel. Thanks for listening, and we will update you with other trade ideas just to understand that there is some, I think, broad-based overvaluation in the market here. Couple things that when I talk about overvaluation, this is one of the areas in the newsletter that I wrote about this week. S&P valuations, we're probably a little bit higher than 28, 23. We're almost 29 times forward earning in the S&P, and nobody thinks that the price to earning ratio in the S&P matters until it does, right? So it's a little expensive. Expensive sectors trading above historic PE average. Define historic PE averages. It's the 5, the 10, and the 20-year PE ratios. We have technology, healthcare, industrials trading well above those levels. The cheap sectors, energy, financial still, which the regional banks is what's helped lift the Russell, and that's why I still think that's great exposure on a dip into the Russell. And utilities are still trading at lower PE ratios relative to their 5, 10, and 20-year averages. So anyway, value players that might explain in energy why crude oil is still under 70, trading around 68 or so. But energy stocks weren't throwing it down any further. So just to wrap this up, look, ConocoPhillips isn't on the lows and making newer lows. That's just one example. PSX, Phillips 66, it's off the lows. So maybe value players are coming in here thinking they're buying cheap relative to price to earning ratio values in here. And that might have some implications in the days and weeks ahead if people decide to take profits in the more expensive sectors, as I mentioned, technology, healthcare, and industrial. So something that we'll be following along. Thanks for listening. If you like what you hear, as always, give a thumbs up. If you want more, just type in the comments, hey, we'd like to hear about this. And then give me a heads up of what you would like me to cover on these YouTube snippets, and we'll put it out there for you, gang. Thanks for listening.